Today on the bottom line, more market highs and yellow flags. Bitcoin splits and then soars. And will we have tax reform? Julia Coronado lets us know. Another week, more new highs on the market, at least before the North Korea nuclear holocaust scare kicked in midweek. Is this market unstoppable? Where does it go from here? Lots of strategists on Wall Street still very bullish, but more and more warning flags are coming out. This week in particular, Jeff Gundlach, the legendary bond manager, came out and he said there's a trade that is so obvious, he's describing it as free money. What is that? He is looking at a measure that we've showed you before on the bottom line, the VIX, which measures volatility. It's sometimes referred to as the fear index. Basically, in the past, when the VIX has settled into a level that is as low as it is now, and in fact, it has not been as low as it is now since the 1990s, it has then responded by jumping into huge volatility, usually on the downside. Jeff Gundlach looks at that and says, hey, it is so obvious that scare and fear is going to return to the market that we are going to make something like 400% on our puts. He's betting that over the next few months we'll see a sharp downturn, return to volatility. So a warning from someone who's been right a lot in recent years. Then another much longer term view that we've been talking about is just the valuation of the market. Last week we showed you a chart that showed that valuations across many measures for stocks are now very close to the levels they reached in 2000, right before the big crash. These are the highest levels in history other than that particular point. And valuation, as we've talked about, is useless as a short-term indicator. It doesn't tell you how to time the market, doesn't tell you what stocks are going to do next. They can always get more expensive. But what valuation has been good for in the past is giving you a sense of what your long-term return is likely to be. In short, when you start with a high valuation, as we have today, usually the long-term return is low. When you start from a low valuation, you usually have a high return. So obviously, everybody should keep that in mind. Fund manager John Hussman of the Hussman Funds, who's been very strong on pointing out where we are in valuation, drew an interesting chart last week where he looked at the valuation versus 2000. And one of the big differences there is that in 2000, it was really just the technology stocks that were extraordinarily expensive and dragging up the whole market. Now, as he points out in this chart, the whole market is expensive. Basically, what he's done here is look at each decile of stocks in terms of valuation, top 10%, then the 10 to 20%, and measured them relative to their own valuation over time. And what you see is that although the top sector, the most expensive stocks, are not at their most expensive point in history, pretty much everything else is. And so what's the meaning of that? Meaning is that unlike 2000, where if you moved out of technology, there were other places in the market where you could be comfortable that you had some valuation protection. Here, there really is nowhere to hide. So what does that mean for you as an investor? What should you do? What smart advisors will tell you to do is just simply manage your expectations. Realize that where we are, what could happen given where we are, which is a sharp downturn. So have the right outlook. And then secondly, and most importantly, just balance your portfolio such that you're able to weather a downturn if we get it. That is always a good strategy, and that is what folks would recommend. I think you would not find any smart advisor saying, hey, you got to get out of the market or what have you. We just can't time it that carefully. So stay balanced, understand what your expectations are, and we'll obviously follow the valuation story going forward. Bitcoin, new highs for everyone's favorite cryptocurrency this week, and also some big news. We'll get to that in a minute. First, let me give you a review of our take on Bitcoin. We talked about in a previous segment how this is the perfect asset for a speculative bubble. What does that mean? Well, there is a good story around it. There's a limited supply. There is no intrinsic value. Nobody can say what Bitcoin is actually worth at any given time. And there is some utility to it, and the use of it continues to increase. So you put all that together, you have this marvelous asset for a speculative bubble. We've said in the past that Bitcoin could go to 1 million, and it could. There's really nothing preventing that. Or it could go to $1, so you could use everything. And some speculators look at that equation and they say, hey, you know, if things go really well, I could get 10x, 100x, 1,000x my money, and all I can lose, meanwhile, is everything. So I'll take that trade. And that's perfectly fine speculative logic as long as you are willing to lose everything. And I think anybody investing in Bitcoin has to be willing to do that or they are deluding themselves. So what happened this week? Bitcoin forked. What does that mean? Bitcoin, oddly, is run by a community of people, and they decided that they wanted to change the underlying structure, and there was a big argument about whether they should do that for main Bitcoin, whether they should create a new currency. Ultimately, the folks who wanted to create a new currency won, and something called Bitcoin Cash was created. What is Bitcoin Cash? It's basically just another cryptocurrency. It has the same basic kind of structure as Bitcoin, and it shares the name, but now it's a separate currency. If you owned some Bitcoin, you got some Bitcoin Cash. Effectively, the supply of the two currencies has been increased. Now the question is, what happens to the value? So far, things are looking good. Bitcoin has continued to move higher since the fork, and Bitcoin Cash, although it started out as a very high price, the price has come down, but has not completely collapsed. So folks who own Bitcoin doing very well. But this is the sort of thing that if you do believe in the future of Bitcoin, you have to watch. Now that Bitcoin Cash is out there, the question is it going to be adopted, or are people going to start to use it? We think that the most important fundamental chart that you should follow tracking Bitcoin is the actual transactions every day. And over time, that's been increasing, which is good news long-term fundamentally for the currency. But now the question is anybody going to use Bitcoin Cash, or is it just going to be a speculative plaything? Doesn't have to succeed, could go to zero, wouldn't hurt Bitcoin if that happened, but now effectively we have two cryptocurrencies to go with the other passel of cryptocurrencies out there. Unless Bitcoin Cash actually becomes useful in terms of people using it to exchange value back and forth or buy things with it, it will just be a purely speculative plaything, so watch out for that as well. But at this point, Bitcoin still on a tear. Will there be new highs in the future? We'll keep watching. One of the big debates in economic circles these days is whether robots are going to steal all of our jobs. There have been such progress in artificial intelligence and robotics recently that the fear is that human beings will have nothing to do. Robots will be better at every single job, and we will sit around and watch the world be taken over by the machines. Is this something that you should worry about? Well, history actually suggests that the economy is very good at adapting to technological change. And there was a great article in the Wall Street Journal this week written by their economics correspondent, Greg Ip, where he went back to the invention of the spreadsheet. Excel, Lotus in those days, and VisiCalc first, and noted that the fear at the time was that the spreadsheet was so efficient, so good at advancing our massaging and manipulation of numbers that it was going to put all sorts of bookkeepers out of business. And what Greg showed is that in fact happened. The number of bookkeepers actually declined very rapidly. But at the same time, spreadsheets created lots more other jobs around that for financial analysis and projections and all sorts of things that you couldn't do before Bitcoin. Sorry, before the invention of spreadsheets. But what does that mean in the grand scheme? It means that technology changes things, but that ultimately the economy adapts. Another example that we should all keep in mind is that a couple hundred years ago, 80% of people in the United States worked on farms and is in agriculture. Now, 2% of the economy works on farms, and yet we still have very low unemployment at this point, so the jobs have been created. So what does it mean, again, for you and for the economy? First, important to note that if it is your job that is affected by technology, it is a very painful process. It is not always clean. It's easy to step back and say, look, the economy will take care of itself, but if your job's eliminated, it's going to create tough times. And then we have the problem now of pay, which is that a lot of high-paying old jobs in manufacturing and other industries are being replaced by low-paying services jobs. Lots of people think that there's something inherent about manufacturing that pays a lot of money and that services should pay low. In fact, it is actually a choice. We just haven't decided to pay people in services business as much as we did in manufacturing businesses. And those things will take some time to resolve, so there's a lot of dislocation in the economy. But overall, the economy is an ecosystem. Jobs are continually destroyed, and more jobs are continually created as a result of that. So in our view, the fears that robots are going to take all the jobs is overblown. A lot of excitement when President Trump was elected that we are finally going to get tax reform, which is supposedly good for business. That is not going to happen, according to our guest Julia Coronado, who sat down with Sarah Silverstein this week.
I'm Sarah Silverstein. I am thrilled to be here with Julia Coronado, the founder and president of Macro Policy Perspectives, which is a market-focused economic research firm.
That's right.
Thank you so much for joining us.
It's my pleasure.
So last week we got new jobs data, and you've talked about a little bit about the hidden trends under the jobs data.
Right.
Can you tell me about that?
Yeah. So one of the big questions is, how big is the shadow labor force? We know a lot of people left the labor force during the Great Recession. It was such a horrible job market. And now the job market's pretty good. It's humming along. How many of those people will come back? That's really the open question. And low wage growth is telling us there's a lot of potential there. And we are starting to see people coming back into the labor force.
And who's coming back into labor force?
Well, this is what's really interesting. When you look by age group and by gender, you see that millennial women and women in general are coming back in pretty significant numbers. More than 2/3 of the people coming back over the last 2 years have been women. And the millennial women are participating at the highest rate in decades. And it's a very interesting development. So there definitely is capacity there. People want to work, and it seems to be the ladies that are taking the jobs. So.
And what's the economic impact of this millennial women wave back into the labor force?
Well, we have to see. I mean, the gap, so it's still the case. And when I'm talking about millennials, I'm talking about 25 to 34-year-old, that age group. And in general, men participate at higher rates than women because women during that age group, some of them leave the labor force to care for children. And so there's always a gap, and there still is, but that gap is the narrowest it's ever been. So what does that mean? What does that mean for marriage, for child rearing, for home ownership? I think there's a lot of interesting questions, and it's definitely a difference from prior generations, something that's new and unprecedented.
And another thing you follow really closely is the Fed. And I read in one of your research reports, really interesting, that you aren't entirely convinced that the Fed tightening is already priced in fully.
Well, look, I think I give the Fed complete kudos for being extremely careful and methodical about communicating their plans. They've been very clear. They've gotten it all out there. And for those of us, like myself, like bond market investors, who parse every single word of everything every Fed speaker says, we get it, right? So it's hard to argue that it's not priced into, say, the Treasury market. But are credit investors focused on every word of the Fed? Do they even understand all of the machinations of the Fed balance sheet and all these complicated plans that they're laying out? Equity investors, is that their primary focus? We actually, at Macro Policy Perspectives, we do a survey of investors. It's a shadow survey of the Fed survey, and we asked them, to what degree is it priced in? And there's a lot of uncertainty amongst investors, amongst people that actually take risk. Yeah, we know it's going to happen. Is it priced in? A lot of people are uncertain, and a lot of people think that there's pricing in yet to come, that a lot of it lies ahead.
Interesting. And the monetary policy, is there a difference in how impactful it can be on inflation now versus in the past?
Oh, I definitely think so. I think what we're learning, and we see this, it's a global process. Inflation is an increasingly global process. And so the ability of any one central bank or one domestic economy to drive, be it wage growth or consumer price inflation, is very limited. It's a collective development. So we see developments in China as relevant to domestic US consumer price inflation. There's a limited ability for any company to raise wages or raise prices when they're competing globally. So I think it really has become a more global process, and that's a challenge for the Fed because our economy is doing relatively well. Our labor market's tight, the economy's humming along. They should be normalizing, but inflation just isn't cooperating. So why would you raise rates if inflation is this low? It's a conundrum that they are having to strike a balance with.
And you've talked about the two different stories told by the bond market and the stock market.
Yes.
What does it mean that they're not on the same page, and which story do you believe?
Well, so both markets saw a Trump rally, if you will, where there was all these expectations of stimulus, fiscal stimulus, and deregulation, and both markets started pricing a lot more in the way of growth and inflation. Then as this year has unfolded and we've seen a lot of disarray and chaos on the policymaking front, expectations in the bond market have started to sort of leak out. So there's the yield curve has flattened, bond yields have come down a little bit. It's a much more subdued, cautious view. Meanwhile, the equity market just keeps charging to the moon and not reacting to these developments. So I tend to think that the bond market is, dare I say it, smarter, that they're a lot more macro focused, let's put it that way. And that a lot of automatic forces like passive investing, like index funds, may be driving the equity market to a greater extent than the bond market. So I don't think that we're going to get a lot in the way of fiscal stimulus. I think inflation is going to be low for long, and so that view has really been expressed more by the bond market.
And last question, what is the one thing you think everybody is getting wrong about the economy or the markets right now?
I think that probably there is still a lot of anticipation of fiscal stimulus. I think that's still probably the consensus view. There's this idea that tax reform is easier than health care. I take the other side of that, that health care, like tax policy, affects everybody in the economy. There's vested interests, and it's not simpler. It's one reason we haven't seen it in 30 years. So I think that you're entering an election year next year. You're going to be negotiating this after having not delivered on health care, giving corporate tax cuts. The politics of that are pretty tricky. And so I actually put pretty low odds that we're going to see a tax package passed and enacted next year. And I tend to think that what that means is that as the Fed tightens policy, we're going to see GDP growth slow down to trend something closer to 1.5 next year. And so that's a slowing trajectory. That may not be the consensus view priced into the market right now.
Thank you so much for joining us.
It's my pleasure.
If you want to dig into the details of portfolio management, how should you think about sector allocations? We sat down with Denise Chisholm of Fidelity Investments to talk about that. Denise, great to see you. Great to be here in Fidelity's awesome chart room, which we'll talk about in a minute. But let's start with the tech bubble, as people want to focus on. Tremendous performance for at least some of the leading FANG tech stocks and others. Lots of people very worried that it's another 1999. Are we in a tech bubble?
So I do historical probability analysis for Fidelity. We have great internal data sets with great resources. And I think history can really lend a lot to this discussion. And there has been a lot of discussion is this a tail event? Are we seeing something toppy in the market? And we can assess that in at least 3 ways, if not many more. The first is looking at cap-weighted versus equal-weighted. Cap-weighted has outperformed equal-weighted, suggesting that maybe a certain portion of stocks are really responsible for the bulk of the gains. But if you look at that 6-month change going back to 1980, we're barely off the historical average. And if you plot that on a histogram, we aren't anywhere near a tail event. And in fact, when cap-weighted outperforms equal-weighted, in the magnitude that we've seen, it actually has good odds for the market on a go-forward basis, not suggesting there's any kind of reduced probability of advancement in the S&P. Another way to look at it is people talking about just a handful of stocks, really representing 50% of the gains in the market. Again, sort of a commonality. Usually when the market goes up, people forget with our 8% historical averages. But when the market actually goes up, it goes up in excess of 20%. So what we've seen actually is some modest gains historically. And when you look at those modest gains, it's very typical for 50% of the market to actually on a median basis account for just a handful of stocks, about 13 stocks, which is about where we are now. And again, that has good go-forward odds. And the third way is really discussing technology specifically. Since I view the market through sectors, we can look at any leadership, specifically here technology, but going back in time, any leadership, the top sector versus the second best performing sector, the average, or the least performing sector. And we're, again, dead on historical averages. And what you see, which I think makes sense to people, is if you put like a business cycle indicator over that, like say leading economic index, you'll see that the market gets more narrow as the economy deteriorates. And you can see that we're dead on where we should be for this point in the cycle. So the way I look at it, I don't see any tail event based on history.
And yet, can stocks like Facebook, Google, Netflix, Microsoft, and others that have performed so well for so long, is it unlimited? Just continue forever? Or you're just saying, look, there's nothing that looks out of whack historically on valuation or other ways of looking at it?
So I think number one is, does anything look like a tail event? In the absence of
Tail event
being something extreme. So tech stocks outperforming so much that it reduces your odds and you only have 30% odds on a go-forward basis. But barring that any extreme measure, which we're not seeing, you have to go back to assess the critical drivers of each sector. And that's really key. And for technology, there's three: ROE, operating margins, and relative earnings growth. And actually what we've found over the last year is technology has struggled on an operating margin basis, return basis, and relative earnings growth has actually been negative. So excluding this last 6-month outperformance period, what you saw was very overlapping outperformance, if any, in technology. So it really held it back. So going forward, what you need to think about as an owner of the technology space is, what do I think about those critical variables? Now, I can tell you that when I look at them, when relative earnings have contracted, you do have good odds at that snapback. And we're seeing leading indicators, most specifically in terms of CapEx to sales, which technology companies have reduced across the board almost, and being a leading indicator to margin expansion. So I think that those are the key things that you need to watch going forward. And if we see maybe 1 to 2 years out margin deterioration, that's when you need to worry about your technology positions.
So your guidance to Fidelity portfolio managers and clients is, hang in there. Mm-hmm. Like, everyone is overweighted on tech, or at least has a lot of it. It's working very well, but no worries, hang in there.
Right, and specifically on a growth tilt, because what you're seeing for the first time really in a couple years is that growth is actually cheap relative to history in technology. Right now, over the last year, it's been dominated by cheap growth names in financials and industrials. Tech has just recently joined the party. And with valuation spreads at all-time tights, we look at a bunch of different valuation indicators, it suggests that growth will continue to outperform.
So let's talk about sector analysis in particular. How does an investor, professional or amateur, use sector analysis to have better returns?
So our process is different than most people's process. Historical analysis really does have a play in sector-based analysis. So we combine both macroeconomic data, fundamental data, and use it in a probability-based approach. Obviously, not everybody can do that, but sectors are a very, very unique asset class because they're so diversified in terms of the spread between the top performing sector and the worst performing sector, much bigger spread than, say, value or growth. You can use them in a variety of ways. We use them at Fidelity to produce alpha. If technology is going to be one of the best performing sectors, then we want to be more exposed to technology and, say, less exposed to, say, utilities. But other investors can use those as solutions and as baskets to enhance their portfolio. One of the unique things about sectors is that you can bucket them into defensive sectors and cyclical sectors. And the defensive sectors have a very clear pattern in history. Value and growth don't have those similar clear patterns. So when you look at consumer staples, healthcare, utilities, and telecom, historically, if you just equal weight those, you've had in excess of 80% odds of outperforming in a down market. But you actually don't give up. If you extend your time horizon, you don't give up outperforming the market over long cycles either. So your risk reward is quite positive. So if you're an investor that says, I don't know how to use sectors, you could use that as one of your solutions. Say, this is a portion of my money where I want to be exposed to equities, but I want it to be just a little less volatile, and I want it to outperform if there is a downturn. You can use sectors in that fashion as well.
And so which sectors are poised to outperform from here, and why?
So I think to know where we're going, it's important to understand where we've been. So what we saw was what I would call, from a historical perspective, a very traditional defensive rotation from 2014 to 2016. And that was based on the fact that profits contracted. We didn't economically contract, but you see all the time profit recessions, usually half the time, I should say, profit recessions without economic recessions. 1998 being the closest example we have, but it happened in 1994, 1966, 1986, 1987, that era. So this does happen. What we see is, despite the fact that there is no economic recession, stocks behave in a fashion almost as if there is in this defensive rotation. And a defensive rotation is when those sectors that we talked about being the stable sectors, consumer staples, utilities, healthcare, telecom, because you buy your toothpaste, you go to the doctor, you turn on the lights, you always have your cable on or your phone. Those are more defensive than the cyclically oriented sectors of technology, financials, industrials, where you might not, if there's troubled times, buy that additional iPhone, get that bank loan, or buy that lawnmower, right? So you see that separation, and that separation is fairly typical over time in terms of the alpha. So what we went through from 2014 to 2016, in my view, wasn't necessarily based on interest rates, low rates, bidding up. It was all based on the corporate profit recession that we saw. So if that was the key theme that got us here, that is the key theme that we need to think about as we emerge from that. And what we've seen is global leading indicators have stabilized and turned up. It looks to be a durable global expansion, not just led by the US. And if you look at history, you can see that profit cycles are correlated to investment spending cycles, and they typically last 2 to 3 years. So with that as your framework, I think it's important when you do sector analysis to have a backdrop, because it allows you to do that. You can make sort of bigger, higher level bets. And then for each individual sector, have the fundamentals and valuation working for you. So with that, you have to be pro-cyclical, say shifting away, tilting away from the defensive areas, and looking for sectors like financials, technology, industrials, and discretionary that both perform well in that corporate profit recovery backdrop and have their own pluses in terms of fundamentals and valuation.
So those are the four?
Those would be the four.
Denise, thank you very much.
Thanks for having me.
Thanks, everyone. That's our show for this week. A big thank you, as always, to Fidelity Investments for presenting the show and to NASDAQ MarketSite for hosting it. We'll see you next week.